Are you planning on selling put options for weekly or monthly income? If so, this is the only video you'll need to know on how to sell puts safely for consistent weekly and monthly income. I'll be covering the specifics of how to pick a strike, expiration, delta, technical analysis, and I'll have 3 live trading examples and all of the steps I use to sell puts to grow my personal portfolio. I've been trading for 9 years now and have combined my experience with teachings from my time at Goldman Sachs, studying under a Wharton professor of economics, and working on the floor of the New York Stock Exchange during my first internship back in college. I'm also going to cover what you must avoid when selling put options and what no other channel talks about because they don't have a degree with risk management experience like I do, which many investors really get in trouble with when they ignore it. Of course, I'm not a financial advisor of anything, but in my opinion, I'm wealthier and more educated than 99% of people, and I'm very excited to teach you how to make more money. I promise if you want to maximize not just your returns, but take the least amount of risk, you're going to want to watch and take notes of this video. I'll be giving you a bonus to increase your returns to risk ratio so you make even more money. So if you appreciate this, all I ask is you hit the like button as it does notify me you're interested in this topic and I should make more videos for you. You need to be sure to pick a proper stock to sell a put option on. A put option is simply a contract between 2 people. As you can see, I have a lot of put options open. I've actually had a lot of put options expiring today. I've been selling put options for nearly a decade now. And a put option is just a simple agreement between 2 people. The buyer thinks that the stock will fall down, so he's buying put options. And the seller takes those shares if they do go down to the strike price. So the buyer of the put thinks it'll go down. The seller of the put thinks that it won't go down. That means that you want to pick a stock you like and would not mind owning, because if it does go down and you get put 100 shares and you have to buy them, then you want to be happy with those shares. And for that reason, I always recommend that you sell puts on high quality stocks. So if you want to sell puts safely for income, the first thing that you want to do is decide on strike, expiration, and delta after picking a stock that you like. Let's use NIO for the first trade. I currently have a NIO position right here at the $9 strike. So check it out. Over the past 1 month, NIO has been as low as about $8.18. For that reason, I have been selling $9 puts and $8.50 puts. Because when I'm selling puts, although that does mean that I hope the stock won't go down, if it does go down, I am happy to purchase the shares. NIO is currently at $9 per share. So let's say that I want to sell a put option at $8.50, which I currently have. Let's go through that example of how much money I could be making. So I'm going to go to trade NIO option, okay? What I do is I like to pick expiration days that are 1 week away or even 1 month away. Now, there is just a preference between 1 week versus 1 month. If you can make $1,000 a week, that's very similar to just making $4,000 a month. So the return is actually very similar. Now, a lot of students in my Discord community will ask me, well, isn't it riskier to do monthly trading because more can happen? And yes, that is kind of true, but it's also not true. Let me just show you both examples. First of all, if I go out 8 days, I can sell an $8 put. So let's go to sell put option. Now, if I go to 8.50, you'll notice here that I'm making about $11. That's roughly a 1% return. It's a little bit higher than 1%, okay? So this right here will give me a 1% return. Now, let me show you an example of going out 30 days. So if I go out about 29 days and I go to sell put option, you can see here that I can still pick the 8.50 put, but I'm roughly getting 4 times more the premium. It's a little bit lower than 4 times more because 4 times 11 would be 44. So in theory, yes, weekly trading is a little bit more profitable, just slightly, but it's also a lot more work. So for me, the difference is actually very small because whether I'm collecting $11 about 4 times or $40 once, that's about the same return. You also do have to keep in mind that if the stock ends up going up, you won't actually be able to sell an $8.50 put for the same price. It'll be lower. So the risk and the reward is actually very similar because they're both the same strike, they're about the same premium. So for me, I'm indifferent between weekly and monthly income. They're both great. Now, what you want to avoid is picking a bad stock or in the money option. So for example, let me get rid of these 2. So let's just say you do want to own NIO. You can actually sell an in the money option like a 9.50 or a 9, but I do prefer to go out of the money. That's because it's very safe and it's very consistent. When you sell an out of the money option at the current stock price is 9 and you're selling say $8 put, well, most likely NIO won't go down to 8. And if it does, that's okay. It's a high quality company. You're getting it for a very good price and you're getting paid to buy it for that good price. It is important to manage this position correctly though. So say I end up selling an $8.50 put. If it goes down to 8.5, I will potentially think about closing this. If it's not a big position in my portfolio, then I will actually want to get assigned and buy 100 shares, because at that point, I can start generating income from owning the shares by selling call options. Now, I want to show you how I do technical analysis. I want to take a moving average of Apple and see where it has been trading for the past maybe 30 days. So for this period, instead of 50, which is the preset for Yahoo Finance, I'm going to put 30 instead. Now I have a line here that shows me the average price that Apple has been trading at for the last 30 days. As you can see, Apple is trading below the 30-day moving average. Now I'm going to go over and I'm going to go into indicators and I'm going to click Bollinger Bands. And Bollinger Bands are just a simple way for me to understand where Apple is going to trade in terms of its high point and its low point in terms of its standard deviation. All that really means is where Apple is likely to be traded based on this indicator. So after I use this indicator, you can see that Apple is near its low of the Bollinger Band. Now I also look at RSI, you can see here that it's 46, which means to me that Apple is somewhere in the middle of its trading range. It's neither oversold nor is it overbought. Now I see Apple had a lot of consolidation around the 119 level. So one time it was at 119, another time it was at 120. Again, it was around 119.99. So I see there's a lot of support for Apple right at the 120 level. Now I'm going to go back to Robinhood, and what I'm going to do here is I'm going to click Trade Apple Options. Now Apple is $128 per share, and what I'm going to do here is I'm going to go to Sell Put, because this is what the video is about. I'm going to show you guys exactly why I sell puts and what level I do it at. So this week is May 14th. However, I want to go out at least 1 month so I can capture a decent amount of premium and not have to trade weekly with this single trade. However, I'll show you more weekly trading in the next stock that I pick. But for Apple, it's a little bit less volatile, meaning that you don't really want to do weekly options because they're not going to have as much premium as a monthly option will have. So what I'm going to do here is I'm actually going to go out 1 month and go for June 18th. And now I'm going to take a look at the option chain. So this is what an option chain is. It gives you the strike price, it gives you the break even, it gives you the chance of profit, and it gives you so much more information. Now, I did tell you guys that the 120 level has a lot of safety and a lot of support around it. So for me, this looks pretty good. However, if you take a look at the premium, $1.51, or as I've said earlier, it's going to be $151 because it is 100 shares. Actually, this is a decent return. It's just slightly over 1%, but in a month, I want to make a little bit over 1%. So for me, the 120 level is just not risky enough. Also, if you take a look at the 122.5 strike, you can see here the break even is actually $120.41. That's because when you take the strike price and you subtract the premium that you collect, your actual break even price would be $120.40 because of that premium that you collect. For me, this is a much more safe trade. However, it does have some decent premium and I do want to have this in my portfolio. So this is a great example for me to show you guys. So what I'm going to be doing right now is I'm actually going to click this little plus sign right here, which tells Robinhood that I want to sell this put option. You guys can see now that it says short put. Now, all you really have to do is click continue, and I'm going to enter the amount of contracts that I want to trade. For me, I want to enter 3 contracts because I have a decent amount of money sitting around and I want to execute 3 contracts. So here I go, I click 3 and I'm going to put the bid price, which is $2.08. So $2.08 is the bid price and $2.11 is going to be the ask price. Since I'm selling this option, I'm going to go for the bid price, $2.10. I'm going to review this trade real fast. And this trade takes up $36,000 of my capital. So there you go, guys. I just collected $636 for the first trade. Now, last but not least, I want small accounts to also easily take advantage of selling puts. So let's discuss. So today I'm going to be talking about selling put options, even if you have a small account. And I specifically want to show you how to sell put options on SPY. SPY is a position that I have in my portfolio. In fact, I have a very large position on SPY. If I click into SPY right now, I'm going to show you that I have over $1,100,000 in SPY right now. And the reason why I like SPY so much is because the options are amazing. Now in this video, what I want to show you is even if you have a small account, let's say it's just a couple $1,000s, you can still sell put options on SPY. I'm going to show you a loophole. With this loophole, you can basically sell puts on SPY without needing to have all of the collateral or capital to actually dump into SPY. So let me just show you an example. So if I go to trade SPY options, I'm going to show you this loophole. So essentially, the thing that I mentioned that I like about SPY is the liquid options. Now you may be like, what are liquid options? So let me back up for a second. Let me tell you what liquid options are. Let me tell you what expiration points I like for SPY. And then also, I need you to understand how to close this position. It's really important because so many people enter into positions and they don't end up closing the position properly. That's probably the number one mistake that so many beginner option traders are doing. They're either entering positions with no plan to exit, or they're just exiting with, not enough profits. So that's what I'm going to change for you in this video. So make sure that you do stick to the very end. But if you look at the options right here, so let's go to sell put options. So I like selling put options a lot because they bring in premium, and also because I'm kind of bullish on SPY, especially because the market has been crashing. I want to sell puts. I want to be out there making money on fear. And there is a lot of fear in the market right now. And the higher the fear goes, well, the more expensive these premiums become, so the better selling put options becomes. Selling put options is a very basic strategy where you're just selling one put and you're collecting money for selling the option. The worst thing that can happen is the stock can fall down, and then essentially you're forced to buy 100 shares. But again, that's not so bad if you're bullish on the stock. And the second thing is, if you sell an out of the money option, you really make your chances small for the stock to fall down to that strike price. And again, SPY is an expensive stock. It's $374. So let me show you an example. Let's say that the expiration date for October 7th, which would be tomorrow, we're going to sell a put option for, let's go to chance of profit. I like to look at my chance of profit, and 88%. So this is good. If I expand this option right now, the delta is 0.12. So very small delta. This 0.12 delta means there's only a 12% chance of this option expiring in the money. So let's go ahead and sell the 367 put option on SPY, and you're going to see the first problem that I come into and the problem that I'm going to solve for you in this video. So if I sell this, it's going to be $59. Now, that is cool. $59 is great. However, the problem is that I would need to have 100 shares of this stock. And that means that I would need to have $36,641 at my disposal. And this is a lot of money. Obviously, most people don't just have 36 grand sitting in their portfolio. But don't worry, because I'm going to be solving this problem. And also, just so you know, you don't need a lot of money to grow a small portfolio. It's not like I started with a lot of money. I started with just $2,000. And it did take me a lot of time to grow, but that's why I'm here on YouTube. I'm here to share my knowledge to make sure that you can do a similar path to me, but hopefully a little bit shorter and a little bit less painful. So how do I solve this problem of needing $36,641 when selling a put option? All right, so we're gonna do this example on October 7th, and let me just expand this option, expiration dates, just to take a look. I wanna see if there's any better expiration dates. Now, what I do wanna point out for you is that SPY actually has expiration days on Monday, Wednesday, and Friday. So actually, this is Friday, this is Monday, Wednesday, Friday, Monday, Wednesday, Friday. This is really unusual, and it's actually why SPY is so popular. It's such a big ETF that so many people have in their portfolio, and the options are just purely a dream. They are so nice because of multiple factors. Not only do they expire 3 times a week, so you can basically sell options or buy options on a very short amount of time. You can do it for the next day, or you can do same day options, which by the way, I also want to show you in this video. But the options are so abundant and they're expiring very often. Now, one thing that you will notice when I expanded this option is, aside from the delta, which, okay, that's cool, is the volume, okay? The volume is massive, 21,000 volume for SPY. That's what I mean when I said liquid in the beginning of the video. Liquid means that there's a lot going on. Imagine this. Imagine if you're trying to sell a car and you have a Rolls Royce or a Lamborghini Huracan 2010, okay? It is not as easy to sell a luxury vehicle than it is to just sell a simple Toyota Corolla. There's a lot of people in the market for Toyota Corollas, and a lot of people have 8 to 10 grand to spend on a used Toyota Corolla. So you can easily sell a used Toyota Corolla in probably like a couple days, especially if you set the right price. If you're just $500 below the market, someone's gonna call you up and say, I want that Toyota Corolla. But for a Lamborghini Huracan, it might take 3 weeks, 3 months. It's really difficult to find a buyer, and even if you lower the price by $5,000, it's still a luxury niche vehicle, and not everyone's going to be able to afford it, obviously. Only a few select people, maybe like the 1%ers, can afford that type of car. So you're gonna have a hard time selling it, even if it is for a discount. And that's basically the same thing with options. For SPY, it's like a Toyota Corolla. There's always like a buyer, there's always a seller, there's always so many people looking to buy and sell this stock, and the options are just really liquid because everyone's also looking at the options and they're also trying to buy and sell the options. So that's why the bid in the ask spread, if you see right here, it's 0.59, and then the ask is 0.61. That's amazing because it's so tight. As a beginner, you really need tight bid-ask spreads. It's going to help you lose less money, which basically means that you're going to make more money in the long term while trading options. Now, I can show you this option that expires on Friday. However, when this video comes out, I want you to have some time to actually potentially make this trade. So instead, I'm going to go out until Wednesday. Super cool and unique because I've never showed a Wednesday option on this YouTube channel. But let's go out until Wednesday. So basically that gives us a few trading days and gives us the weekend as well. So I'm going to go down to a reasonable strike price. And for me, that's going to be analyzing the option chain. So again, I want to look for an option around an 88 chance of profit, because that 88 chance of profit also means that the delta is around 0.12. And that's because the chance of profit is inverse to the delta, meaning that a 10 delta means 90% chance of profit. A 5 delta means a 95 chance of profit. So I already know that, and I know how Robinhood platform works. And I also know that I like a sweet spot of around 10 to 14 delta. So 12 delta is fine, and the volume here is 2,400, so not as much. Let's go up a little bit, 3,812 volume, that's really good. Let's go up one more, and it's also 2,000 volume, 15 delta, that's a little aggressive. So I like the 362, the volume is pretty good, the delta is pretty good, and the bid-ask spread is amazing. It's exactly $1. So let's go ahead and sell this option right now. I'm going to sell this for $1. It says 99 cents, but it's going to be $1 because the midpoint of 99 and $1.01 is going to be $1. So yeah, the midpoint is $1. So I'm going to sell this for $1. And again, we have a problem of 36 grand. So what I'm going to do now is I'm going to try to get rid of this max loss. And the way that I'm going to do it is I'm going to buy a put option that is way below. So I'm going to tell you the risks about this trade as well, but first of all, let's go buy a put option, okay? So we're currently at 362. Now, obviously, I can just buy the 361. However, this only gives us a total credit of $10. That is not that unique. This is basically a put credit spread. But that's only $10. That's not that good compared to the $99 or the $100 that we wanted to collect originally. So instead of going down one leg, I'm going to go down a bit farther. So I can actually go all the way down to 352. Now, going down to 352, you can see here that the delta is 0.04, the volume is 2,800, and the bid and ask is still very, very tight. In fact, it's even tighter. It's only $1 apart. So that is great. Now, if we will notice, things become really interesting. So basically, I can sell the 362 put. Robinhood is fine with that, and every broker is fine with that. However, if you don't have the collateral, you won't be able to actually fill this trade. But now that I am buying the 352, I'm basically creating a floor for myself. If the stock were to drop, it cannot drop below 352. Well, if it does, it's not a problem because now my buy put is going to protect my 362 sell put. Now I can pay $31. That's not that much money compared to $100. And I can take home a total credit of $69. So It says right here my max profit is roughly $70, but my max loss is $930. That is true. You can lose up to $930 and you're making $70. However, this is basically the same thing as selling a put option on SPY. You still have a very similar risk profile. You're still collecting a really good sum of money, and now you don't need $36,000. You need less than $1,000 to enter into this position. Now, the risk to this position and how to close this position. Two really important things you need to know. First of all, the risk of this position. There's a few different risks. The first risk is if the stock ends up falling, you can get into this red zone. If you get into this red zone, then you're going to end up losing some money, and then you're going to have to close the position. Now, before I tell you exactly how to close the position, the number one risk of this position would be someone that would open up too much of it. If you open up too much of this position right here on SPY, it would most likely work out well, but the one time it doesn't work out well, you could end up losing a lot of money. In fact, a very significant amount of money. However, that may only happen, if I expand this 352, about 4% of the time. So if you were to do this 100 times, literally 96 times, you're going to end up making $70 for less than $1,000 worth of risk. And that $70 is going to represent an over 7% return in just a few days. So obviously, if you were to do this in theory 96 times in a row, you would have like 1,000 or 5,000% gain. So you'd be able to scale your portfolio from like $1,000 to basically $7,000, something crazy like that, right? You'd be able to 7x your portfolio in 5 days, around 100 times. So that would be in like a year and a half. So you could take a portfolio of $1,000 to $7,000 or $10,000 into $70,000. But there is a caveat. 4 times out of 100, you're going to have an issue. This position would go into this red area. So 4 times out of 100, you're going to have to close the position. This is very important. Depending on how well you close is really going to depend on what type of return that you have. Now, you can have a 7,000% return, right? From 10K into 70, or if you don't close properly, then you can turn $10,000 into $12,000. So really big difference, very huge difference from 10 to 12 and then 10 to 70 grand. And I'm not gonna lie, I'm not perfect myself. I don't know the exact perfect time to close, but there are rules that I follow that are very useful for me. And the first rule that I personally follow is when I'm doing this type of position, for example, the share price for SPY is $374. That is the current share price. What I personally do is if the stock goes down to say $363 per share, okay, right outside of my strike zone, I put a warning on this position. I watch it very closely like a hawk, and I tell myself, okay, it is in a dangerous point. It's very close to being in the money. And as soon as this position basically looks like the momentum isn't so good, if I don't see the chart going back up or there being a really good support level at 363, as soon as it goes down to 362, I will jump ship and I will close this position. I will close this position for either a gain or a loss. And it depends. If this position gets really close to October 12th, let's say it is actually October 12th, and this position reaches 362, well, actually, that's not that big of a problem. Because it's the last day, and because theta is so high, let me expand this option to show you. Theta is basically time decay. And because this is so huge, I will keep watching this position like a hawk and not really close it until very end of the day on the expiration date, which here would be Wednesday. So on Wednesday, I'm gonna keep waiting. As long as this is at 362, I actually don't need to close it because it's on the last day. I'm only going to close it if the option goes to like 361 or 360, and then the option turns negative. As soon as it turns negative, I'm going to be looking to cut my loss at a 10% loss. What that means is, for example, if this position has made me $70, as soon as it's down like $7, which is really close, right? I'm going to just cut the position, all right? And I'll end up having like a $7 or $10 loss, a very, very small loss. I will end up closing the position. However, let's say that the stock goes down to 362 before October 12, like really, really soon. That's really rare. That might happen even less than 4 out of 100 times. Maybe it'll only happen 1 out of 100 times or 1 out of 300 times. Still, I will look to close the position in a very similar way. I will end up closing at around $362 per share if it goes into the negative and close at around a 10% loss. Now, sometimes when I have a lot of belief in the stock, I won't close for a 10% loss. I will close for around a 25% loss. And in some extreme scenarios like Tesla, where I really want to hold it until the last day, I will decide not to close it early and instead to hold the option until the last day of expiration and then close on the last day of expiration. So that's exactly how I would treat and close a position like this one right here. And this is exactly how you can go around selling put options with a small portfolio and actually still scale a small portfolio. If you want to see me scale a portfolio from $7,000 to $17,000, I have a new program that I just launched. Check it out in the description. You can also book a free call to chat with me or someone on my team to learn more about my challenge and follow all my trades that I have. Thanks for watching.